Welcome back to the week that was. If you've been watching the charts over the last few days, you probably deserve a medal.
Or at least a stiff drink.
Seriously, we are unpacking a week that was, frankly, just one of the most chaotic we've seen in a long, long time. Calling it volatile doesn't even begin to cover it.
It really doesn't.
Yeah.
I mean, we started the week comfortably in the mid-90s. We were all thinking, okay, this is a quiet consolidation phase.
Right.
And then just out of nowhere, the market gets battered by what I can only describe as a perfect storm. It was this collision of geopolitical absurdity and huge macroeconomic shifts.
And it sent Bitcoin dropping down to, what, 87, 88,000?
Lows near 87, yeah, before it finally found its footing.
It just felt like the floor fell out. And I think the big theme here, the question that kept popping into my head as I was watching all that red, was the sort of crisis of identity. You know, we always hear these two competing narratives. Is Bitcoin digital gold the ultimate safe haven? Or is it just a high beta tech stock that panics whenever the NASDAQ sneezes?
That is the trillion-dollar question. And, you know, looking at the stack of reports we have for this deep dive, it feels like we got a pretty definitive answer this week.
And it wasn't the one some people wanted to hear.
Not for the digital gold maximalist, no. The market decided pretty unequivocally that Bitcoin is still behaving like a risk asset.
So to get to the bottom of this, we have a massive amount to unpack. We have to talk about a trade dispute over an Arctic island, which, I know, sounds like a joke.
It sounds made up.
It does, but it absolutely wasn't. Then there's this forensic accounting of two major corporate treasuries taking the exact opposite bets. And we need to look at the plumbing of the industry itself.
Which was really creaking under the pressure. It's a fascinating case study in how interconnected everything is now. Nothing happens in a vacuum anymore.
Okay, let's start with the headline that had me checking if I was hallucinating. The Greenland shock.
You weren't the only one. I mean, this triggered a massive reaction. The reports outlined this really rapid escalation where President Trump threatened 10 to 25% tariffs on several European nations.
But the condition for lifting them was the kicker.
Right. They had to cooperate with a U.S. deal to either purchase or secure rights to Greenland.
It sounds like the premise for a political satire. The market didn't laugh, though, did it?
The market hates uncertainty more than anything. And this is where we got that crystal clear answer to the digital gold versus risk asset debate.
Ah.
When this news broke, look at what gold did. Physical gold. It rallied to an all-time high, hitting $48.35 an ounce.
The definition of a flight to safety.
Exactly. Investors fled to physical history.
And Bitcoin
Did the exact opposite. It crashed. It behaved just like a risky tech stock. The algorithms saw a trade war. They saw global instability. And they sold Bitcoin.
So they sold Bitcoin to buy gold and Swiss francs.
Yes. A brutal, brutal decoupling. In a moment of actual fear, Bitcoin didn't act as a shield. It acted like a tech stock with higher leverage.
At least for now.
At least for now. But then, just as quickly as it started, we got the Davos détente.
Détente. That's pronounced détente, right? A relaxation of tension.
Exactly. And by midweek, during the World Economic Forum, a deal was struck. The specifics are kind of interesting. Greenland gets integrated into the U.S. Golden Dome missile defense system.
And in exchange, the tariffs were canceled.
The risk vanished, and Bitcoin recovered back toward 90K.
So crisis averted. But while everyone was staring at the Arctic, you've highlighted something in the analysis that seems, I don't know, more technical and maybe more dangerous.
The situation in Japan, this is the silent killer.
Okay.
While the headlines were screaming about Greenland, the Japanese government bond market, the JGBs, was imploding. Yields on the 40-year JGB hit 4%.
That's a 40-year high.
A 40-year high.
Okay, so break this down for me. I think a lot of people hear Japanese bonds and their eyes just glaze over. Why does a bond yield in Tokyo matter to a crypto trader in New York?
It matters because of global liquidity. It's all about the mechanics of the yen carry trade.
The yen carry trade.
It's crucial. For decades, interest rates in Japan have been, well, basically zero. So big institutional players borrow yen for next to nothing.
Okay.
They take that borrowed yen, they convert it to dollars, and they buy higher yielding assets like U.S. tech stocks or Bitcoin.
So it's basically free leverage. You borrow money for free to go gamble on riskier things.
That's it. It's the engine of global risk-taking. But when yields in Japan spike, like they did this week, the cost of that borrowing goes up. Suddenly that free money isn't free anymore.
And investors panic?
They panic because their loan interest is spiking. So they have to pay back the yen loans. And to do that, They have to sell their most liquid assets to get the cash.
And Bitcoin is very, very liquid.
It's the most liquid asset in the world, trading 24/7. So it gets sold first. It's the canary in the coal mine.
That makes so much sense. So it wasn't just fear over tariffs, it was mechanical. It was forced selling.
That's the key takeaway. It was a liquidity squeeze. You had the geopolitical fear acting as the spark, but the Japanese bond market provided the fuel.
And that fuel led to an explosion in liquidations. I was looking at the on-chain data.
Yeah.
Over $1 billion wiped out.
It was a cascade. When mechanical selling meets fearful selling, the price just falls through the floor.
Yeah.
And this brings us to one of the most fascinating stories buried in the on-chain data this week.
The hyperliquid whale.
The saga of the hyperliquid whale.
I saw this in the notes. Wallet Zero Eyes B317. This reads like a psychological thriller.
It really does. So this entity had a massive long position. They were betting the price would go up. When the Greenland news hit and the price crumbled, well, they got liquidated.
For how much?
They lost $25.8 million in a single click.
25 million. Gone.
Yeah.
I can't even wrap my head around that. I think most people would just crawl under a rock and never look at a screen again.
Most people would. But this is where it gets really interesting. And it tells us something about the market right now. Immediately, and I mean immediately after that $25 million loss, this same wallet opened a new long position.
No way. They doubled down.
They did. Put down a fresh $38.7 million bet that the price would recover.
That seems aggressive. Is that just pure gambling, or is there a strategy there?
I mean, it borders on it, but it highlights two things. One, the extreme conviction some of these big players have. They saw the drop as a glitch, not a trend change.
And two,
It shows the sheer amount of leverage still in the system. When you have players willing to throw almost $40 million back in after an 8-figure loss, you have a market that's just a coiled spring. It just amplifies the volatility.
and speaking of whales, we also had a ghost from the past show up, the ancient whale from 2012.
Right. A wallet that hadn't moved in over a decade shifted about 909 Bitcoin, roughly $85 million worth.
And naturally, social media went into meltdown. Everyone thinks it's an early adopter cashing out to go buy an island, maybe Greenland.
The timing was suspicious, certainly. But the forensics suggest something else. The coins moved to a pay-to-witness public key hash address.
That's a mouthful. Plain English.
It's just the technical term for a modern SegWit address. It's a standard, more efficient format for holding Bitcoin.
So not a sale.
Well, if they were selling to an exchange, the transaction would likely look different. This is more like a custody upgrade. Someone moving their old, dusty coins into a more secure, modern vault.
So probably not a dump, just housekeeping.
It looks unlikely, but it still spooked the market. Supply from the Satoshi era always feels like a bad omen.
Okay, so we have individual whales acting crazy. But what about the corporate whales? This week gave us a perfect compare and contrast between two big companies.
The tale of two treasuries. On one side, you've got GameStop. On the other, MicroStrategy.
Let's start with GameStop, the diamond hands company. You'd expect them to hold through anything.
Well, it turns out maybe not so diamond-handed with their Bitcoin. The on-chain evidence is pretty damning here.
What'd they do?
GameStop had accumulated a position back in May of 2025, buying near the top around $107,000 average. This week, forensics showed they transferred 4,700 BTC to Coinbase Prime.
And for anyone listening, moving to Prime usually means one thing, right?
It almost always signals an intent to sell for cash. And the timing was just terrible. They appear to have sold in the $89,000 to $90,000 window.
Ouch.
So if you do the math, that's a realized loss of somewhere between $76 and $81 million.
They bought the top and panic sold the bottom. That's almost impressive in a bad way.
It appears so. And there's a huge lesson here. It just shatters that narrative that once a corporation buys Bitcoin, they never sell. GameStop proved that non-crypto corporations can be weak hands.
When a traditional CFO sees red, they liquidate.
Exactly. They don't have the ideological conviction.
Now contrast that with Michael Saylor and MicroStrategy.
A completely different strategy. During the exact same chaos, while GameStop was allegedly selling, MicroStrategy bought another 22,300 Bitcoin.
For how much?
For $2.1 billion.
At what price?
Around 94,000. So they were buying into the volatility.
It's incredible. One company treats it like a hot potato, the other treats it like oxygen.
And there's a third player entering the mix now that might be even more important in the long run.
Who's that?
Delaware Life Insurance.
Insurance companies. That sounds, well, boring.
Boring is good. Boring is exactly what this asset class needs to mature. Delaware Life launched a Bitcoin-linked annuity. This is a retirement product.
So this is sticky money.
Incredibly sticky. Insurance companies aren't day traders. They aren't GameStop. If they're building products around Bitcoin, they have to hold it for decades to back those liabilities. This is the bridge from the crypto casino to actual generational wealth.
So you've got the traders fleshing out, the weak corporations folding, and the insurers stepping in. That feels like a maturation point.
It is. But maturation doesn't mean the plumbing works perfectly yet.
Which brings us to infrastructure. We saw some serious cracks in the system this week. Let's talk about the BitGo IPO.
This was a big moment. BitGo Holdings went public on the NYSE. This is a picks and shovels play. They do custody, security. You'd think that kind of business would be stable, right? Distinct from the price of Bitcoin.
But looking at the chart, that is not what happened.
It was a roller coaster. It priced at 18, popped to 22, and then crashed to 1450 right alongside the Bitcoin spot market.
So Wall Street still can't tell the difference between the vault and the gold inside it?
Not yet. There is no decoupling. Investors still treat these infrastructure stocks exactly like high beta proxies for the asset itself. If Bitcoin sneezes, the custodian catches a cold.
And speaking of catching a cold, DeFi had a rough week. We have to talk about Paradox. This story actually made me nervous.
It should. Paradox is a layer 2 derivatives exchange. They had a technical glitch, an Oracle failure, that caused the price of Bitcoin on their platform to display as $0.
Zero.
Flat zero. And because the system thought Bitcoin was worthless, the liquidation engines kicked in and just wiped out user accounts.
That's a nightmare scenario. But what happened next is the controversial part, isn't it?
Yes. The team executed a rollback.
Ray rollback.
They basically rewound the blockchain to a point before the glitch occurred.
Wait, I thought the whole point of crypto was immutability. You can't just hit undo.
That is the core ethos. But here, they use an admin key to reverse time. Now, on one hand, it saved the users money, which is good.
Right.
But on the other, it raises this massive philosophical question.
If a small team can reverse the chain whenever they want, is it really decentralized?
Or is it just a database with extra steps? It exposes the centralization risk in a lot of these layer 2s.
And it wasn't the only drama.
Not at all. We saw Trove Markets, a project launching on Hyperliquid, pivot to Solana at the last second. The token launched and collapsed 97% almost instantly.
97%? This sounds like a rug pull.
There are allegations of fraud, bait and switch, funds being diverted to gambling addresses. It's a total mess.
Yeah.
It reminds us that the on-chain frontier is still the Wild West.
But it wasn't all bad news for tech, right? We saw some serious speed records get broken.
Yes, this is the counter-narrative. Mega ETH.
Mega ETH sounds like a transformer.
It acts like one. It's a new layer 2. They ran a global stress test this week and hit 47,000 transactions per second.
47,000. Put that in context for me.
It challenges Solana directly, whose whole selling point is speed, and it rivals traditional payment networks. If an Ethereum layer 2 can hit that kind of speed, it suggests high-frequency trading, the kind Wall Street does, might actually be viable on Ethereum soon.
So the pipes are getting wider, even if they sometimes leak.
That's a fair analogy.
Let's zoom out to the physical world. We had some weather impacting the network, specifically in Texas.
We did, a major winter storm. And this highlighted the miners as good citizens narrative.
How so? I usually just hear people complaining about energy use.
Well, here's the flip side. As the storm hit and heating demand spiked, Bitcoin miners in Texas, who are massive energy consumers, powered down. They curtailed their operations to release that electricity back to the grid for homes and hospitals.
So the network hash rate dropped.
Dropped about 15 to 25%. But the Bitcoin network didn't flinch. Blocks kept coming. It proved that miners can act as virtual power plants that stabilize energy grids during a crisis.
That's a great PR win. And speaking of wins, we had some movement on the regulatory front. The SEC versus Gemini case.
This is significant. The SEC dismissed the case against Gemini with prejudice. That means they can't bring it back.
And why did they drop it?
Because the investors were made whole. Gemini users got their money back, and they got it back in kind. They got their Bitcoin back, which is now worth way more.
So the SEC is setting a precedent here. No harm, no foul.
Essentially, yes. It signals a shift from regulation by enforcement to restitution equals dismissal. If you fix the problem, the regulator might back off. That's a huge de-risking event for other exchanges.
And at the state level, Kansas is making moves.
Kansas is discussing allowing state pension funds to allocate up to 10% into Bitcoin ETFs.
10%? That seems incredibly high for a pension fund.
It is aggressive, but it validates the state maxing thesis that individual U.S. states will start hoarding Bitcoin to hedge their own fiscal health. It's becoming a sovereign balance sheet item.
But then you look over at Vietnam.
A different story entirely. Vietnam set a $400 million capital requirement for crypto exchanges.
400 million, that's just a ban in disguise.
It basically bans any startup. It hands the market to the giants. It stifles innovation.
So, bringing it all home, we started the week fearing a trade war over Greenland. I still can't believe I'm saying that. And we ended it with Bitcoin finding a floor near 89,000.
We did. And if you look at the flows, the weak hands, the leveraged traders, the GameStops, they all washed out. They sold into the fear. And the strong hands, MicroStrategy, the pension funds, they stepped in.
It feels like a transfer of wealth.
That's exactly what it is, a transfer from the impatient to the convicted.
So what's the big takeaway for someone trying to make sense of all this?
I think the takeaway is that despite the volatility the structure is holding, the Greenland shock proved that Bitcoin is still tied to global liquidity.
Yeah.
It's not immune to the world.
Right.
But the recovery and the buying behavior of institutions proves that the demand is real and it is deep.
It's a bigger boat, but it's still in the same stormy ocean.
That is a perfect way to put it.
Before we wrap up, I want to leave you with a thought. We saw Mega ETH hitting 47,000 transactions per second. We saw the SEC backing down because users were made whole. So the technology is getting faster, the laws are getting clearer. But the price still crashed because of a trade dispute over an island in the Arctic.
So it raises the question, has Bitcoin really matured? Or is it still just a high-speed reflection of global anxiety? If a tariff threat can wipe out $1 billion in an hour, maybe the safe haven narrative is still just a marketing slogan. And we have a long way to go before it's truly digital gold.
Something to think about. That's it for the week that was. Thanks for exploring the chaos with us.
Until next time.